Good morning, traders. Welcome to the Flow Show, and a bit of a flip around in the pound. Thanks to our good friend over at the Bank of England, Mr. Bailey, which we'll talk about in a moment. Quite a bit to get through. I'm keeping half an eye on my trading screen because I'm trading through these pound moves. So if I have to head off to do something, you'll have to excuse me. But trading comes first. Right, let's kick off. Japan, Ishiba still waffling on. Yesterday he said the economy is not in an environment for an additional rate hike. Again, the market took that as a dovish comment that may be going against the BOJ's grain. But it was just another comment that is in line with the Bank of Japan, because if the Bank of Japan thought they were in an environment for additional rate hikes, they would hike. And we know they don't. We know they aren't. So they're not going to hike yet. He then added that he wants to make the economy strong with economic packages. They're obviously watching what's going on in markets over there, because we then had overnight the Chief Cabinet Secretary Hayashi saying that PM Ishiba didn't request the BOJ governor to conduct any specific monetary policy when they met on Wednesday. Finance Minister Kato says that the specifics of monetary policy should be left to the BOJ, and that Ishiba's comments are based on the BOJ's explanation. He's also got an eye on markets, being finance minister, because he says it's important that FX moves in a stable manner, reflecting fundamentals, and they are watching currency moves with a sense of urgency. So he obviously picking up Suzuki's notes as he left them on his desk after leaving his post. There has been a big move in dollar yen yesterday. It went over 300 pips, which is, by definition, intervention territory for officials over there. Very strong moves at the moment. Again, a lot of this is the market seeming that the government is being a bit dovish. I disagree. I think they are sounding more cautious, but I don't think they're being dovish. But the market's going to do what the market's going to do, and we've still got high volatility here, so it's no surprise to see some big moves. I'm also a bit sore that I wasn't still long from the 143s and 142s after seeing it rocketing up to 147s. Instead, I managed to lose 25 odd pips shorting it last night up into this 146.50 level. So yeah, couldn't make money, so I decided to lose money on it instead. A small tight trade there. We did have a break of 147s, but it's pretty much matched these other spikes that we've had back in September, and prior to that we've had these little spikes up 20s, 30s. So maybe a bit of a zone needs to be drawn here, but we've not got and held above 147 in all these moves, so that still makes this number the big one to watch. If we fail to do it here, we're having another little test as I speak. If we fail to hold it there, we could then see a bit more of a top forming, but I'm not sure whether I want to fight that again. We've had one of the BOJ bods out, one of the more dovish sounding, Noguchi. He says we must patiently maintain loose monetary conditions. We need more time to have a 2% inflation mindset. But he did concede the BOJ will likely gradually adjust the degree of monetary support while cautiously examining whether inflation stably hits 2%. Accompanied by wage gains. So the slow approach for the Bank of Japan continues. And again, I think that's another thing playing into some of these yen moves. The market is judging these comments and this rhetoric from Japan through the same lens that it does every other central bank. Okay, just like the Fed, one piece of data and we're trading 25 pips, another we're trading 50 pips of cuts. It's a very goldfish market, very short-term thinking. That same thing cannot be applied to the Bank of Japan. We know this was always going to be a very slow and cautious process, and thus it remains. But it seems the market likes to get very excitable about it anyway. Over in New Zealand, Kiwi Bank has joined the 50 cut mob. They say the RBNZ will cut by 50 next week. We've obviously had some data out today as well, more PMI data out. It's Services Day today. That kicked off in Australia, which saw a miss of expectations, lower than last month, down by a pip on expectations there. So creeping down in their numbers as well. Japan also seeing their numbers coming in softer than expected, 53.1 from 53.9. We had some Swiss data out as well, and a bit soft on the CPI front, minus 0.3 on the month, 0.8 versus 1.1 expected and prior on the year. The EU harmonised number also coming in lower, 0.9 versus 1% previously. The core CPI coming in at 1% versus 1.1%. So that's going to keep the S&P on the front foot in terms of being dovish, softer CPI there. Going through the rest of the data, Spain, again, surprising. They surprised to the upside in their manufacturing. They've surprised even better on their services number, 57 versus 54 was expected to drop from 54.6 previously, but it came in much stronger. Italy, the services number also there coming in weaker, much like some of the others. Spain still the standout really in the Eurozone, missing expectations by a chunk, coming in much lower. France saw an improvement over their flash number. The flash was 48.3, that big drop as the Olympic effect washed out, but it seems there was a bit more bean counting to do over there, because the flash actually improved by 1.3 points, which is quite a significant revision for the final number. So maybe there was a little bit of leftover Olympics in there that helped improve that number. Germany just confirmed their drop from 51.2, the final number matching the flash number, and the pan Eurozone number 49.6, again an improvement. That's probably driven by France and Spain. Coming into the UK, oh sorry, no, that was the composite. There's the services final, which again still improved, 51.4. UK as well, flash number 52.8, final number 52.4, a little bit softer. Some of the comments within that pointing to a bit of a moderation in unemployment, but there's still some price pressures playing out there. There was also what's called a decision makers panel, which is a BOE survey of firms. They have some CPI expectations, which still stayed pretty sticky. Then over the next 3 months, inflation expected to remain at 3.6%. 1 year expectation actually went up to 2.7% from 2.6%. Within that survey, though, someone highlighted on Twitter that the jobs metric has shown zero growth in employment for September, which is the lowest since COVID or before COVID. Again, could be a reason why Mr. Bailey decided to chuck an interview out. Before we get to his nibs, we'll go over to Germany and talk about talking your book. German Chancellor Scholz saying it's wrong to shut out foreign competition and narrow the circle of trading partners. He calls for more talks with China on electric vehicles. There's a vote going to be happening by EU countries as to whether to enact further tariffs and restrictions on China's electric vehicles. Of course, Germany's in the thick of that. What's become abundantly clear, they put a lot of their eggs in the China basket, and all these issues with China is blowing up in their faces. One of the reasons why the economy is doing so much worse. But Scholz wants to try and keep that momentum going, or keep their business with China going. He says that the EU Commission needs a fundamental reorganisation on the issue of competitiveness. Again, as I say, book talking 101. German Economy Minister Habeck He's not a happy bunny. He said further interest rate cuts are coming too slowly for me. He wants the ECB to speed them up. No shit, Sherlock. I'm not sure Spain would agree that faster rate cuts are needed. But some of you may not understand the importance of Germany calling for rate cuts in such a way. They are historically market hawks, monetary policy hawks. So if these guys are shouting for further rate cuts, you can see that they're really in the shit over there. And probably, as I say, much to the joy of others like Spain. ECB's Vasley says he cannot exclude or commit to an October rate cut. There will be more rate cuts, but they will be data dependent. Hope he's not getting splinters sitting on that fence. One of the doves, Centino, says the state of the economy needs an ECB response of reducing rates. ECB Schnabel, another German, says we cannot ignore headwinds to growth. At the same time, monetary policy cannot resolve structural issues. Growth across the Eurozone has become increasingly uneven. That's a polite way of saying our economy is shit, but everyone else is doing a bit better. ECB's De Guindos says all options are open for an October decision. Right, over to His Majesty at the Bank of England, who decided to pop up and says that he sees a chance of more aggressive rate cuts and that the Bank of England could become a bit more activist on rate cuts if there's further good news on inflation. Now, first and foremost, on first blanch, you obviously think, well, okay, that's a big dovish turn, which it is compared to his other comments. It is full of possibles, chances, ifs, coulds, maybes. That's one caveat I'd throw in. But as we know with the pound, if it's going to move, it's going to move bigly. It's not often one that moves slowly to these things. So I think we've seen probably a bit of an overreaction to all this. Cable, it's been a bit like pushing in an open door, what with dollar strengthening largely around a lot of pairs. So, it's not as if it wasn't moving that way already. It's just been, given a bit of a trip to help it a bit lower. What has been the surprise, though, is euro sterling. That's a real rocket, up nearly 100 pips, which is a big move just for a little bit of a hawkish turn. I think that might be a bit overdone. Not that I'm complaining. I'm long. As people in the room will know, I'm long down here at the 83.20s. So I'm loving it. Been slicing and dicing, but I don't know. It's going to take a bit more, I think, to get us through this zone here. So I wouldn't be surprised if we find resistance here as we are at the moment. Maybe we settle down a bit. Maybe we move into a bit of a higher range where we had this 20s, 60s. Maybe we go 60s, double O's, something like that. But it's probably likely that we've seen this taking on a bit of a bid tone, and now cable is a bit of a rally sell rather than a dip buy for a while. We shall wait and see. UBS, they've thrown out their thoughts for the ECB. It's UBS Global. They said the ECB could cut rates to 1 to 1.5% if growth does not pick up in the coming quarters. Amazing. All these banks, everyone, financial institutions, market players, they always get far more dovish than they do hawkish. So that's good for us because if everyone gets extreme too far one way, we know that's a potential fading opportunity. But we shall see. ADP yesterday, again, confounding everyone's, all the dovish, all the doves, all the bears, coming in above expectations, 143,000 from 124, 125 expected. The prior 99 revised up 4K to 103. Decent spread of job gains across the service sector. So it's all still looking like the jobs market isn't ready to roll over. Obviously, this isn't there isn't a strong correlation with the NFP except for the trend. So you never know what we're going to get on Friday, but still, just when you think the markets or the US is ready to roll over, or looks like it's going to roll over, we get a positive number that brings it all the way back again. Fed's Barkin said a 50 pip rate cut in September was warranted because rates were out of sync with the decline in inflation. He said the unemployment rate is near its sustainable level, and that 50 basis points of cuts shown as the medium from the dots for the rest of 2024 would also take a little bit of the edge off rates. So he was happy with the 50, and he's happy seemingly with another 50 through to the end of the year. In Mexico, the deputy governor said that monetary policy should stay at its current rate level for more time. So not looking like they're going to be cutting again anytime soon. The port strike in the US, port operators say they have no plans for discussions today or in the near term. So it looks like this thing is going to drag on. The longer it drags on, the more it's going to backlog, the longer that backlog is going to take to clear. As Blake pointed out in our chat room yesterday, for some reason, Americans are starting to clean out shops of toilet roll because they think there's going to be a shortage. Why fucking toilet roll? Why was it toilet roll during COVID, not food? Anyway, the funny thing about the toilet roll situation is that it's produced in Los Angeles, I believe, so it's not even affected by port strikes, or it's shipped in via LA, which aren't affected by port strikes anyway. So you go and answer that question, why toilet rolls are so important in the US. I would say it's because you lot talk so much shit, but I won't. Anyway, little dig to our American friends. US Deputy Secretary of State Campbell says it's not just Israel that is thinking about response options to the Iran attack. So the US making clear that what Iran has done may face severe repercussions and not just from Israel. That's it on the headline front. Thankfully, got through all that lot. Let's have a look at what's coming up in the data today before we get stuck into more charts. Not overly big set of numbers early on. Keep an eye on this Challenger job cuts. This is something that is going to spike up if we ask to see some decent size layoffs coming in. We heard about Samsung yesterday. I'm not sure if their US operations will filter into these numbers. They may do. This is going to be closely watched. The last report said that hiring had slowed to the lowest on record according to their survey. Still watching to see if we're going to slip from low hiring to firing. Jobless claims, hard to think that that one's going to show a shocker, but one point it might do. This might be the week, it might not. If it's not, the market's going to go meh and move on. This will have no impact on the NFP number because it's for last week, so it's not in the survey week for the NFP. Final S&P Global Services PMI still sitting pretty in expansion, so we'll get to see whether that's going to soften like we've seen in some of the others. Bit of factory orders and revised durable goods numbers, but then it's all about the ISM services number. Is it going to be a shocker, or is it going to be another one that confounds what the market thinks about a softening economy? The headline number is expected to rise 2 pips to 51.7. Now, after the manufacturing numbers where we saw big moves in jobs and prices, that's probably going to be the focus for this one as well. Obviously, if we get a stinky employment number, then that's going to play into expectations for the NFP on Friday. Got a couple of other Fed speakers up. Fed Schmid speaking, and Bostic. Well, we know what Bostic's position is. He was happy for 50 cut, happy to do another 50 cut if the economy warrants it, which it doesn't at the moment. It's not even justifying the first 50 cut right now, but Fed's gonna Fed. Right, let's get on to what's going on. I've spoken about Euro Sterling cable. had a couple of levels. This one was fairly significant for me, 131.70, bit of a zone down to 45s. It held up for about 5 minutes and then carved through. Let's go into let's go into a longer term chart first, just to show you that that level, that 31.70 level, because it is quite a doozy. It's a level we've had a lot of action at going back for some time, so going back through the years. So it's just one of those levels, watching it on the way up. That 45 area held when we had this big bounce, quite a significant hold there, up in the 131s all the way down to the 120s. So this is why I keep these big levels on the chart, because when we cross them, when we come to them, it's likely something happens. In this case, not a lot happened. As I say, we held up there for literally about 5 minutes, 10 minutes before carving through. Did the same here, held up there for 5 minutes before carving through. We just hit the next level, just into this 131 area. I've got my number at 131.10. We got to 131.06, so close enough. Into that big figure. So again, another bit of a zone again. Just this is more short-term price action from 131 down to 130.80s, 85s. So that's the area. It's looking for now like that might be a bit of a stretch point. So just keep an eye on that. If you're going to try longs, then this is probably your lower risk area to do so, unless you start getting a break back up above these levels. But I think we're probably going to be in rally sell mode for a bit longer, obviously depending on what happens with the US data, etc. So any big rallies, 132s, 132.5s, may now be seen as selling opportunities for some in the market. Dollar yen already spoken about. Oh, don't want to move that around. Euro dollar still creeping lower. It's mooching down towards this 110 level. Not at any great rate of speed since yesterday. I'm keeping my eyes on this zone again for a potential long. Probably keep it fairly tight given the mood in the dollar at the moment. But the level worked last time it was down here, and you know, a level's a level until it's not. So I've got in mind to give it another go for longs down here, but I'll take any moves down there on their merits at the time, seeing if it's data driven, what that data is, so on and so forth. If it's really strong data this afternoon from the US, then we might put in a little attack on it, maybe even a break, but I'll be interested to see what happens afterwards. If we do break this level, there's likely a ton of stops through here, so we could see a quick flush down, but then what happens after will be key. If we bounce quickly back above it, then that might entice me into longs for that one. Aussie dollar was still trying to hold up, but as I've been talking about, this 68.70 level was the key one. We've had a couple of tries, couldn't get under it. Had a couple of tries, tried to get under it. Now it's looking like it's becoming resistance, and we're having a push further down. So the air is coming out the tires on this one. So this now is important on the way back up. Any retests on that, 68.70s that hold, likely to see a push down. I don't know if maybe there's a bit of or lack of influence from China, from them being closed at the moment. And the fact that this is dropping a bit slower is probably holding up on the back of that China opium trade still. That a boost there will be a boost to them. We're still seeing commodities like copper still keeping their gains, still holding up well. Gold not dipping too far either. So on that front, that's still supportive for the Aussie. As mentioned, China's been closed, but Hong Kong is still trading. That's seen a bit of a soft day. Again, it may be some influence because China's shut. Hong Kong stocks don't really know what to do. It's going to be, I think, very important when China's markets reopen again. I think they open in Monday. I think their holiday runs until the 7th, so into the weekend or just after the weekend. So either 7th or 8th, I think they're back. And if all these stocks take off again, then we're going to be playing probably risk on a bit as well for those. Obviously, depending what has gone on elsewhere in terms of Iran, Israel, US and whatnot. So this is going to be another weekend where you're going to have to be careful with risk trades going in case there's a headline over the weekend. And then we face some gaps Sunday night, Monday morning. Meanwhile, US stocks, they're sitting right on this former resistance zone. So it's a big deal here, right on this level. This is maybe a decider as to whether we're going to see a further dip. If we manage to hold here, it keeps these highs in play. Maybe we just do a bit of ranging. But if we're breaking down below here, then this short-term move above is going to look very fakey. And then we potentially facing a steeper pullback. I'd expect maybe down to the 55.50s. And if we hold there, then we are still doing the stepping up movement, which keeps the trend going. But if we're below there, I need to scrap that for now. If we're back below here and then back below here, then we're going to be down, likely heading towards these lows, and then that's the next level to watch. So very important, this area here could be key for what happens next. As I say, it was the very strong resistance area before the break. So this is the base it needs to build on to go on and take out those highs. Gold, as mentioned, again, not doing too much. Mooching around in this potential range that's formed now. We are, again, 26.40, so that level is becoming something. This one, I think I'm going to boot it out. Let's get rid of it there, because I'm not. It's not showing up as being anything really significant, as opposed to some of these other levels. So as you can see, this is how I build my technical picture. You put in levels that may have something. If they don't do something, you get rid of them and move on until such time as another level develops, or the ones you have get further confirmation. So got a bit of confirmation that this 26.40 is a bit of a level, bigger, potentially still at 26.20s. So the range is forming. So if you're trading this, you know where your break points are. You need to get back above here for a chance of moving higher. If we're going below here, then you know we're probably heading lower. So you can change the range or trade the breaks or do both. Don't have to be pigeonholed into or blinkered into one trade or another. Just trade the levels and take the opportunities when they're given to you. Oil, we're always keeping an eye on oil. A lot of people look at US oil, but I prefer to look at Brent because the Middle East is Brent, not WTI. So you're going to get a bit more volatility here, and it becomes more of a leader than a lagger. It's still retaining its bid, obviously. We're still waiting to see what Israel does. The clock is ticking, as I say. If nothing happens today or tomorrow, there is the potential for something to happen over the weekend, and then you're looking at potential gaps and all sorts going on. So if you are in oil trades, if you're in risk trades, if you're on the risk on side rather than the risk off side, then you need to be very careful. There's nothing wrong with, if you're feeling like you're on the wrong side of potential events, get out your position for the weekend. You can always get back in if nothing's happened the following week, but you don't want to be gapped on a trade, and then you're going to potentially get stopped out nowhere near your stop, or you just blink of an eye, you're well offside. So account protection is the order of the day going into weekends at the moment, and we've still got the headline risk until we get to the weekend. Something can happen anytime now. Yields, as I like to keep an eye on, these 2 years still maintaining this bounce. We are at a bit of a level coming into here, high 360, 370s. Got a bit of traffic through here. It just depends how much the market wants to push this. If we do see good data, we could be heading up to that 370 mark in 2s, 10s. Again, they're just knocking around this 380 level. So it's probably going to take something strong to get us all the way up to 390. But this end of the curve is going to potentially move faster than the shorter end. So I'd expect limited moves up on good data in 2s, but 10s might go a bit further. I think anywhere up 390s, 385, 390s, becomes a bit tempting for bond traders to start buying the dip in the price. So keep an eye on that over the data as always. Gavin says so many 4-hour and daily charts, very similar structures. Yeah, and I'm actually finding myself, because of the volatility. Most of you will know I tend to look at 15-minute charts intraday just to gauge price action for the day and for the week. But I'm finding I'm spending more of my time on the hourly charts just because of the volatility. It is higher, and it's just becoming clear on the hourly charts rather than the 15-minute charts. So you're probably going to see a few more of those when I put them in the room and chat room and on the dashboard. That they're more hourlies than 15 minutes at the moment. But you're right. There's a lot of similar positions or similar patterns showing up. Obviously the dollar's having a big influence. So you're seeing a lot. Aussie dollar, as we said, coming off the high, but holding the support level. Kiwi coming off its highs, holding the important support levels. Cable doing a bit more, but holding the levels. Euro sterling going some, holding the levels. So we're getting these swings, but it has to do more to start breaking some of these moves and these patterns. This is Gregor's dream in terms of waves. It's always, everyone starts getting bearish on things when you see strong moves like this, but take a longer view of things. Take the trend since August. We're still in an uptrend, and if we bounce here, there's every chance we continue higher. Then this just looks like a pullback. People always get bearish at the bottom of moves rather than at the top of moves, but that's another story altogether. Right, you guys and girls, got anything else you want me to look at? Have a look at dollar CAD quickly, though that's still doing nothing. This one's become the new the American Canada version of Euro sterling at the moment. As a bit of a move, then just sits and does nothing for ages. Again, though, it's just caught in the crosswinds of everything else going on. So you've got the risk move, you've got the oil move, you've got the commodity move. So yeah, dollar CAD is probably not one you want to be keeping an eye on if you want a big move, but we've obviously had bigger moves elsewhere, particularly in some of the crosses like Euro CAD. Probably need to do a bit of tidying up on my charts here. So we had this bit of an attempt at a breakout up here. We couldn't, so that potentially keeps us in a bit of a range pattern, quite a wide range, obviously, down to 42s, 43s. Our old mate, 46.5, hasn't been visited for a few weeks, so maybe we're going to get a move down there, our old magnet line that we've watched so often before. The same magnet line we've got in Aussie Kiwi as well, but we've moved away from that. Again, we had another test, middle of September, moved away. We're just up, tapping around this 110, 110.20 area again. I am thinking this has been, again, this is a bit of central bank divergence. Everyone getting all dovish over the RBNZ, going for 50s. This is a risk of a big reversal if they only go 25 next week. Plus, I'm still in the camp where Australia is probably closer to rate cuts than they believe they are. So, don't know if we get if this keeps creeping up, I might consider trying shorts again. I did try it last time in that move and got stopped out by about 20 pips before it collapsed. Yeah, but I might have a little nibble again if this expectation for the RBNZ keeps going over the next few days and keeps pushing that higher. Because what will happen is, if they go at 50, it won't be a surprise. So there'll be even less of a sell-off in Kiwi. That will be the plan anyway. So I'm keeping an eye on that one for potential shorts. The Fed is fedding. Yeah, the Fed's always fedding, mate. Always fedding. Fed's going to fed. That's what they do. Right, anything else for anything else? Well, we got it there. Euro dollar trend. I've mentioned euro dollar already, Tarek. I don't see any trend change at the moment. As I've just said, a lot of these pairs, they're all maintaining this trend. So until we start breaking down through the fibs, this is a big area. This would potentially signal a change in trend if we get through there. Through this 109.90s is probably a level here. If we're under there, then maybe we are turning around this trend, but there's different phases to it. So this will move through here, will be the 38.2 of the July trend. It'll be the 50 fib of the August trend. So there's a trend within a trend, or two different phases, as I say, that would potentially mark that we're changing the trend. But if we don't, what are you going to do? You're going to short it down here. You can short it on a break, but I certainly wouldn't try shorts down here unless there's a big bit of data or something telling us that we should short it down here. Right. We'll call that a day for today. It's been a bit busy already. I feel half knackered sitting down and seeing what the quid is going to do. Have a great day, everybody. Tarek, so you're short. If you don't, you will close your position. You can always keep a little bit on, mate. Tighten up your stop rather than get out. You know, I don't like giving up a winning trade. So if you're short, euro dollar, it's going your way. Just tighten up your trading stop behind. Take a bit of profit. Maybe leave a bit off, leave a bit on, just in case it does break. Or conversely, you can always trade the break if it does go below and get back in. So last bit of advice there. Have a great day, everybody. Stay safe, stay well. We'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.